Welcome, Curious Minds, to Talk Tickers, your essential guide for understanding what really happened in the latest earnings calls. Today, we're cutting through the noise on Domo Inc. That's ticker Domo. We're looking at their second quarter fiscal year 2026 results.
Yeah, it was definitely a quarter with some, let's say, attention-grabbing numbers. And that led to a pretty immediate market reaction, as you might expect. We're going to unpack those figures, really dig into the strategic shifts they're making, and, figure out what it all means for you, the informed observer.
All right, so settle in. We've got quite a bit to get through on Domo's latest performance and where they might be headed. Let's jump right into that immediate market pulse then. After the earnings call yesterday evening, Domo shares took a pretty significant hit.
Yeah, significant hit is right. We saw a double-digit percentage drop in after-hours trading, and the volume was way up too. Really tells you something.
Definitely sent a signal. But, that reaction might seem, a little harsh when you start digging into some of the positive metrics they reported.
Exactly. I mean, yes, the company reported a GAAP EPS that's generally accepted accounting principles, which, fair enough, missed the consensus estimate by quite a bit. But on the other hand, they hit their first ever positive non-GAAP EPS, actually beat expectations there. And revenue also came in slightly ahead of what the street was looking for.
So it's really a mixed bag right out of the gate, isn't it? You've got this clear split between GAAP and non-GAAP profitability. And that definitely seems to have set a, cautious tone for investors trying to figure out the report.
Yeah, definitely some conflicting signals there.
Okay, let's unpack this a bit more then and get into the nitty-gritty of Domo's Q2 performance. Because despite that market reaction, there were some genuinely impressive operational results. Like you said, that first ever positive non-GAAP EPS, 0 and 2 cents. And alongside that, a record non-GAAP operating margin of 8%. I mean, that's up significantly year over year.
It really is. And what's quite fascinating, I think, is the cash flow story here. Domo generated positive net cash from operations $3.4 million. Now, get this. That's a 155% increase compared to last year. And their adjusted free cash flow, $1.4 million, up 125%. These aren't just, small bumps. They're strong indicators of much better financial discipline. Management seems to be getting a handle on costs.
Absolutely. Strong indicators. And then on the growth side, the numbers were, pretty compelling too. Subscription remaining performance obligations, RPO, basically future revenue locked in from current contracts that grew 19% year over year to a record $409.8 million. And maybe even more telling, new annual contract value, ACV, growth actually accelerated. Nearly 20%, that's its highest level in 3.5 years. Seems like momentum is building.
It does, and that brings up the question, right? What's actually fueling this pickup in operations? A huge factor, it seems, is Domo's strategic shift towards a consumption-based pricing model. This is really key. Over 75% of their annual recurring revenue, ARR, is now based on consumption, and they're aiming for over 85% by the end of this fiscal year.
And the impact of that.
Well, what's really impressive is for the customers who started on those consumption contracts, their net revenue retention, or NRR, was 108%. That tells you those customers aren't just staying, they're expanding their usage. They're spending more over time. That's exactly what you want to see with that model.
Okay, and here's where I thought it got really interesting. Digging into their strategy execution. Salesforce productivity growth. It accelerated to a, frankly, stunning 67% in Q2. Just compare that to 19% back in Q3 of fiscal 25. That kind of, that's not just people working harder. It feels deeply connected to their whole go-to-market strategy, especially around partners.
Indeed it is. Domo has clearly been deepening those integrations with the big cloud data warehouse players, Snowflake, Databricks, Oracle, Google BigQuery, you know the names. Plus, they announced a new strategic collaboration agreement with AWS, and that's specifically focused on GenAI and their Agent Catalyst solution. Management actually called these partnerships new freeways for business.
New freeways. I like that.
Yeah. It allows for co-selling, which is huge. And critically, they're seeing much higher closing rates for leads that come through these partners, much more efficient than going it alone.
And the CEO had that really bold statement, didn't he? Declaring that BI as a simple dashboard concept is dead.
He did, and it's more than just talk, I think. It really highlights how Domo is trying to position itself now, not just BI, but an end-to-end modern AI and analytics stack. They're explicitly trying to ride the wave of demand for advanced AI solutions. Things like seamless data access, robust ETL that's extract, transform, load a semantic layer for consistency, workflow automation. They want to be the whole package.
Doing beyond just dashboards.
Way beyond. And looking outside North America for a second, they reported strong international momentum. Japan in particular really stood out.
What happened there?
New ACV in Japan nearly doubled year over year, doubled. And total contract value, TCV, hit all-time highs there. And get this, net revenue retention for renewal deals in Japan was close to 130%.
Wow, 130% NRR.
Right, significantly better than other regions. It makes sense why management called it out as a key focus area. They plan to spend even more time and resources there.
And they gave some concrete examples of customer wins, which always helps bring the strategy to life.
They did, like a 3-year deal with a big home improvement company. They actually replaced Power BI, and it was a joint offering with a CDW partner textbook ecosystem play. Then there was a fast-growing tech customer using the consumption model via a CDW marketplace to manage a data warehouse migration. They also won a big new global retail logo after a long 8-month bake-off against Looker and Tableau, showcasing their AI stuff apparently. And finally, a private equity firm went all in on consumption. Multi-7-figure, 5-year deal. They plan to scale Domo across their portfolio for AI use cases.
Those are solid examples. Really shows the strategy working across different types of customers and needs.
Exactly. Tangible proof points.
Okay, so that's the quarter that was. Let's turn to the outlook. What does Domo expect for the future? Because this is often what really moves the needle for the stock.
Right. And here's probably where some of that negative after-hours reaction came from. For Q3, the current quarter, the company is guiding for a non-GAAP net loss per share.
A loss. After just hitting their first non-GAAP profit.
Exactly. So that immediate dip back into loss territory, even non-GAAP, likely raised some eyebrows.
What's the reason they gave for that expected dip?
Management attributes it to planned investments. Basically, they need to spend some money now to support and strengthen those partnerships we talked about, especially with some significant partner events coming up soon that require that upfront investment. So it's framed as strategic spending for future growth.
A classic investing for growth argument then. Spend now to make more later.
Pretty much. But it's important to look at the full year, too. For fiscal 2026 overall, Domo actually raised its guidance for both billings and revenue, although they still project a non-GAAP net loss per share for the full year. But perhaps more telling for the longer-term view is their updated Rule of 40 guidance.
Ah, yes, the Rule of 40. Always a key metric for SaaS companies. Remind us what that is and what Domo updated.
So the Rule of 40 basically adds together a company's revenue growth rate and its profit margin, usually operating margin. If it's over 40%, that's considered healthy. Domo now expects to exit this fiscal year, FY26, with both billings growth and non-GAAP operating margin at 6%. That's up from their previous target of 5% each.
Okay, so 6 plus 6 is 12. Still a ways from 40, but an improvement in the target.
Right. But maybe more importantly, they also put out a target for the end of FY27. They're aiming for 10% on both metrics by then. So that signals a clear commitment to scaling up those efficiencies and driving towards, consistent profitable growth. It provides a roadmap back to profitability beyond this Q3 dip.
And what about cash flow in the near term?
They expect adjusted free cash flow to be slightly positive for both Q3 and Q4. So even while they're investing and guiding to a non-GAAP loss in Q3, they plan to keep generating a little bit of cash. It reinforces that focus on financial health even while making these strategic bets, suggests they aren't just burning cash recklessly.
Okay, that makes sense. Which brings us back full circle to that initial market reaction. We saw the stock rally going into the report.
Yeah, there was that analyst upgrade focusing on the consumption model and the partnerships.
Right. And then bam, it falls sharply after hours, despite, as we've discussed, quite a few positive operational metrics and raised full-year guidance on some fronts. It's a real head-scratcher sometimes.
It often is with companies in transition like this. I mean, yes, that first positive non-GAAP EPS was a milestone, definitely signaled progress. But the market seemed to just latch onto the GAAP loss, which was wider than expected, and that near-term Q3 guidance for a non-GAAP loss. Investors are clearly trying to weigh this long-term strategic shift, the consumption model, the AI angle, the partnerships against these immediate, even if planned, profit dips due to the investment phase. Which story wins out in the near term?
It's exactly. The company explicitly called fiscal year 2026 a bridge year for these investments. Makes sense strategically, maybe. But for investors, and for us analyzing it, the big questions now are, how fast will those partner monetization milestones actually happen? AWS, Snowflake, BigQuery. When does the cash register really start ringing from those? What will the adoption metrics look like for Agent Catalyst and their other AI solutions? Is it getting traction? And fundamentally, can they keep making progress sequentially back to positive non-GAAP EPS after this Q3 dip? Those are the key things to watch.
Absolutely. Those are the catalysts. And diving into that a bit more, this whole AI infrastructure play narrative is central. The CEO saying buy is dead wasn't just a soundbite. It's about positioning Domo as the plumbing for enterprise AI. Those partner leads closing at 5x to 7x the rate of organic leads. That's powerful. The question for investors is, how quickly does this translate into sustained faster growth? And can they really carve out a niche against much larger players also targeting this AI infrastructure spend?
That's a great point. And the other angle, we touched on that Japan momentum. I mean, nearly doubling ACV year over year, 130% NRR on renewals.
Yeah, that's not just a footnote. Why is Japan responding so well? Is it the consumption model, the specific AI offerings? If they can figure out why it's working so well there and replicate even some of that success globally, well, that signals significant untapped potential. It's a strong validation point for their model, at least in that market.
It really shows the potential if things click.
For sure. So at the end of the day, Domo is trying to position itself in a really hot market data AI infrastructure. This bridge year is about laying the groundwork. The long-term story really hinges on them executing on these partnerships and getting real traction with their AI solutions.
All right. You seasoned quant jockeys and macro gurus out there. Let's shift gears a bit for our not financial advice segment. Let's talk Domo trade ideas. Look, despite the market getting the jitters after earnings, yeah, we saw that after hours tumble. I'm wondering if the street is maybe missing the bigger picture here, fixating on the gab loss, the Q3 dip, maybe it's a forest for the trees situation.
Okay, let's hear it. What's the angle?
Trade idea one, the AI infrastructure play, long straddle. The pitch is this. The CEO said BI is dead, right?
Yeah.
And that Domo's benefiting from very healthy spending on infrastructure and services to capitalize on the promise of AI. They're not just using AI, they're providing the foundational plumbing, the ETL, the data access, the semantic layer, especially through those cloud partnerships that close deals like crazy. Agent Catalyst enabling GenAI workflows. This is infrastructure.
So you're saying the market hasn't fully priced in their role in the AI build-out?
Exactly. The market's current reaction screams volatility and indecision. So let's play that. I'm proposing a long straddle on Domo options. Maybe target late FY26 or early FY27 expirations. Buy an out-of-the-money call and an out-of-the-money put, same strike, same date. The thesis. The market's confused now, but this underlying shift, the AI infra play driving accelerating ACV, that 108% NRR on consumption, record non-GAAP margins before the investment dip it has to force a decisive move eventually. Either the market wakes up to the durable AI infrastructure story and the stock rips higher, or they stumble on execution during this bridge year and it corrects hard. Either way, a big move seems likely, and the straddle profits from that volatility.
Interesting. Playing the uncertainty itself. Okay, now for something maybe a bit more nuanced, building on something we discussed earlier. Did you really catch that commentary on Japan? New ACV nearly doubled year over year, all-time highs in TCV, and RR close to 130%. That's significant outperformance for a company this size. The CEO is spending more time there.
Yeah, that definitely stood out. So what's the trade?
Trade idea two, the Japan momentum arbitrage spread. The pitch here is there's a disconnect. Domo's overall stock price and perception are driven by its global story and U.S. tech market sentiment. But its Japanese operation is firing on all cylinders and might be undervalued within the whole. So, the strategy. Combine a bull put spread on Domo options with a long position in a small-cap Japanese tech ETF that has some exposure to data analytics or cloud trends.
Okay, break that down. Bull put spread on Domo.
Yeah, it's a credit spread. You sell a put and buy a cheaper, further out of the money put. You collect a premium, betting the stock won't fall below your short put strike before expiration. The idea is that the strong Japan performance provides a fundamental floor, making a catastrophic drop less likely, letting you collect that premium.
And the Japanese tech ETF.
That acts as a proxy for the regional tailwinds Domo is benefiting from. If Japan's tech sector keeps running hot, that ETF should capture some upside. It indirectly supports Domo's valuation story, even if the direct link is just their own results. So you're essentially arbitraging the specific regional strength against the broader, maybe more hesitant, global market perception of Domo, leveraging the undervalued Japan piece while getting some broader regional exposure.
A regional arbitrage play within a global tech name. Definitely creative. Okay, that gives our listeners some stimulating food for thought.
Stimulating and definitely not financial advice.
Absolutely not. Okay, and that wraps up our Talk Tickers deep dive into Domo Inc.'s Q2 fiscal year 2026 earnings. It's pretty clear Domo is right in the middle of a major transformation. You see those strong operational shifts consumption pricing, those deep AI-focused partnerships.
Yeah, but while the immediate market reaction was, let's say, negative focused on that JAP miss and the Q3 guide management seems genuinely confident, they're pointing to that raised Rule of 40 guidance as their path back to sustainable, profitable growth.
Ultimately, as we discussed, you'll really want to keep a close eye on those partner monetization milestones. Are they hitting them? How's the AI adoption progressing? And just generally, how well do they navigate this bridge year? That's what will validate the longer-term story they're telling.
And just to reiterate, this analysis is purely for informational purposes. It should absolutely not be taken as financial advice. Always, always do your own thorough research and consult with a qualified financial advisor before making any investment decisions.
Sound advice. Thank you, everyone, for joining us for this deep dive. We'll be back soon with more insights to help you stay well informed.